All right. So today we have a bit of a change of pace. We're going to talk about startups, but in the context of venture capital and investing. And today I have Brandon Jenkins. He is the co-founder and CEO of Fundrise. And welcome to the Data Exchange podcast, Brandon.
Hey, Ben, thanks for having me.
And I guess disclaimer up front, we are not offering financial advice in this episode. This is
No.
strictly a much more of a thematic and an overview of some ideas for how founders might be able to raise capital.
Yes, not investment advice.
All right. So I guess before we start talking about your foray into venture capital or the tech investing space, let's talk about Fundrise itself. So what is it and how did it get started?
Yeah, absolutely. Today, Fundrise is really the first and the largest direct to the individual alternative investment platform in the country. And I think the kind of the two key parts to that are direct to the individual and then the alternative aspect. So what we do that really no one else does is we take alternative assets or private market investments. So private equity, real estate, private equity, venture capital, private credit, asset classes that traditionally are only available to larger institutions, and we make them available to individuals directly through the platform. And it's really a model that we pioneered 10 years ago when we started the company. And again, today is still the first and only place where an individual investor can actually invest directly into those types of assets without either having to go through a series of other intermediaries or middlemen, or kind of be aggregated into part of a larger institutional capital source.
And Brandon, so my first job outside of academia was at a hedge fund, which is in the alternative investment bucket. But so generally, when people talk about alternative investments, it's alternative. So in other words, you have your mainstream investments that capture most of your asset allocation, and then a small chunk goes to these alternative investments. So Fundrise, what categories of alternative investments does it support?
Yeah, so we started in the real estate sector. So real estate, private real estate, owning, operating real estate properties, particularly apartment complexes, industrial assets, and then single family rental communities. We expanded out of real estate or real estate equity into private credit or lending. So fixed income products, again, primarily in the real estate space. And then our most recent expansion is into venture capital or into tech investing. So those are the three areas that we focus on. And again, as you said, that our customer, typical customer, in their world or in their experience, I think most people traditionally have only kind of been exposed to public market investments, so stocks, bonds. And so our typical investor, again, comes to us with, having invested in the stock market through their 401k or through their IRA, but really hasn't had exposure to alternatives. And so seek us out because they're looking to diversify, or again, they've heard, investing in real estate is a great investment, or they work in the tech industry and they understand how attractive venture investing is as an asset class. But for all the reasons that we started the company,
of course, our Gen Z listeners are going, well, I'm in crypto.
Yes, crypto technically, I think you would say, is an alternative. Obviously, there's a debate about whether it's an investment
security at all. Yeah. Hey, yeah. So Fundrise started at a certain point in time, and so why did it happen then? Why not sooner, or why not later?
Yeah, great question. So the company is a little over 10 years old. And we really started off the back of the 2008 financial crisis. And in a lot of ways, that crisis and that recession was kind of the impetus for starting the company. So myself, the other founders, came from a real estate investment background. And we went through that crisis, and there was a lot of things that caused 2008. But I think our kind of simple takeaway was, the financial markets collapsed, and then you had the institutions, the investment professionals who, they ended up getting bailed out and really didn't, end up too worse off. But the individual, the person whose actual money was being invested, those people lost a lot of money. They, really saw some, pretty, terrible results of that. And so coming out of that, we just felt like, kind of to oversimplify it, like the system was broken. The people whose money it was, who were saving, retiring, taking the risks, then the people who were doing the work of building companies or building properties, most of the value wasn't flowing towards those two groups. It was flowing to the people in the middle, who were essentially, more or less brokers or managing the transaction, but taking huge amounts of the profits, but not really taking on any of the risk or the downside from that. So it was coming off the back of 08 that we basically said,
So
why don't we try and figure out a different way to do this?
So something like Fundrise, right? So for people listening to this episode who are quite tech savvy, so what does it take to do something like Fundrise? So there's the tech platform, which I guess you can build. I mean, FTX is a tech platform built off of QuickBooks, apparently. But so the tech platform, let's assume that you can build that. So what else goes into doing something like Fundrise?
Yeah, it's the combination of the technology part, which probably a lot of your listeners are more familiar with, and then the security side of things. So, when we started the company, you couldn't actually just go around and ask anybody if they wanted to invest in, a property or in a company. There's a process you have to go through in terms of, following different securities regulations. And so when we started Fundrise, it actually wasn't possible. It wasn't legal in a lot of ways to go around and ask individuals, the average, investor, not ultra high net worth people, if they wanted to invest in private assets. The way the securities laws are structured, you basically have public companies which have to go through a public registration process, and that's open to everyone, or private investments, which is this whole other world that most people don't know about, and that's more or less exclusively walled off from the individual, and can only be accessed by.
So Brandon, for people who don't follow this closely, so let's take the asset class real estate, right? So someone listening to this might say, well, I already have exposure to real estate either through my house, let's say if I own my house or have a mortgage, or I can do that through investing in one of these diversified REITs, the real estate investment trusts. So what's different here?
Yeah, I think that's a perfect question. And the analogy I often use is actually think of it as technology companies. So a public REIT is a lot like public tech companies that you could invest in. So if you invest in, the NASDAQ ETF, investing in a public REIT ETF is very similar. You're investing in very, very large, mature companies, just like there's a private market for technology companies where startups get funded through venture capital and growth equity and kind of grow and scale and then mature and go public. Real estate goes through a very similar process. Properties are bought, when they're raw land or they're kind of run down, and then they get redeveloped, they get leased up, and they kind of turn into a mature, stable property, and then they get sold into the private markets. The difference in real estate is instead of a company basically going from being venture owned to IPOing, what happens is in the real estate context, the real estate property itself goes from being owned by a private equity fund to being sold into the public markets and bought by a REIT. And so a lot of what Fundrise does, whether it's on the real estate side or the venture side, is about giving people access to the asset earlier in the life cycle while it's still in the private market. And there's, couple things that make that attractive. One is generally the returns are going to be stronger, they're going to be higher. And then there's typically a lot less volatility. And so if you look again at big professional institutional investors, they tend to allocate a pretty sizable portion of their portfolio to alternatives, to privates, because of that, higher return profile. And so
It is
that's
the Yale model, right? So
yes, yes, the Yale endowment made it famous.
Yeah.
And it's, again, if you're a person who's thinking about investing long term, a lot of the things that make the private markets attractive are a great fit, because if you're not trading on planning the asset planning on trading the asset every day, then the need to have the liquidity that the public markets provide isn't necessarily that valuable to you.
So the so one of the things about hedge funds and traditional alternative asset classes is there's not much correlation with your main investments, number one. Number two, supposedly. Number two, I guess you have exposure to things that you normally would not have, right? So you have potential upsides that you may normally not avail yourself of, but then there's some risk involved, right? So the main thing is liquidity risk, right? So
yes.
So the REIT that we're talking about, you can just sell that anytime, right?
Yes.
So, yeah. So what are the risks for this model?
Yeah, liquidity it's the big one. That's exactly right. So really, alternative investments or private investments like what we do at Fundrise, they're a good fit if you're planning on holding long term. So if you're talking about long-term savings, retirement dollars, things like that, you're not planning on trading, you're not planning on needing the liquidity, that asset class being illiquid can come an advantage. It's not good for someone who basically is, wants liquidity, wants to trade in and out of the market, or really needs the liquidity. So one of the things, when anybody comes to the platform, the first thing we do is say, like, look, this is not like stocks. This isn't like, basically buying and selling in the public markets where you can get liquidity at any time if you need it. This is illiquid by design. It's not a bug, it's a feature. And so, do not invest any money that you don't feel comfortable with being locked up for 5, 7, 10 years at a time. It's really, again, it's designed that way on purpose. But that's the risk.
So that's basically part of the onboarding.
Yeah, it's, we ask you 3 times to acknowledge it before you put any money into the platform, because again, it's critical, not just for that individual, but for all the individuals on the platform. The risk for the collective group investing on the platform is if you have people who don't kind of understand that, and then you have a period where the market slows down and they want to pull all their cash out, well, that's actually to the detriment of everyone else who's invested alongside them in those funds. So we actually wrote a letter, and it basically says like what to expect from your Fundrise investment in a downturn. And I think there's a giant, bolded, called out section that basically says, like, if there is a downturn.
People are reading that letter right now.
I hope so. We email it out to every investor on the platform within their first 60 days.
So we've been talking, so a lot of our examples are in real estate, right? So now you folks are starting to get into tech investing. But at a specific stage, which is Series B and beyond. So would it be fair to say that, what you're doing is kind of like AngelList for Series B and beyond? No.
I'd say it's similar in that we're trying to open up access to a broader group, but I would say it's different in that we're trying to give people access to almost an indexed approach, or kind of a diversified investment across a series of companies, rather than I would think an AngelList. A lot of times people are kind of specifically looking for a company, 1 or 2 companies that they feel very strongly about to invest in. A lot of what we're trying to do for our investors is give them access to the asset class of kind of late stage, growth
So
equity.
very similar to like in real estate, you're not buying a specific building or house, right? So,
Right, right. And a lot of our, again, customers, they're not, they're not experts in real estate investing, and they're not experts in venture investing. So they don't come to us looking to try and, pick winners or kind of pick stocks. They come to us more or less to say, this is an asset class that I'd like to invest in to diversify. I want exposure to it. But I'm not an expert. I'd actually like you to kind of invest for me across a sector, across an asset class. Very similar to how someone, in your 401k, you might own an all market Vanguard ETF. It's really about getting exposure to the asset class rather than picking out individual companies.
so why Series B and beyond? Why not start earlier?
Yeah, it's a great question. I mean, the way we think about it is that, there's this narrative in venture about, the kind of expert investor who is turning, over, companies and looking for this like needle in the haystack. And they have this just, unique ability to kind of understand like,
Yeah, the model is built on maybe 99 losers and one humongous home run, right?
Right.
Yeah.
And our, I guess, opinion is that when you get to, particularly now as the industry has matured, when you get to a Series B or later, it's not really a secret who the great companies are. If you take a sector like, a lot of the areas you talk about, look at data or say like data orchestration, it's not really a secret who are the 5 companies that are kind of leading in that space. Everyone actually knows who they are. And so this idea that like you need this expert venture investor to kind of identify those companies, I think to us is a false narrative. Once you get to the later stage, what we say is it's not an identification problem, it's an access problem. Everyone actually knows who the 5 really strong companies are in that space. It's a question of, can you get access to invest in them, not who they are. And so earlier stage, again, I think there's, we believe that there's a different type of like skill involved in assessing companies kind of pre-product. But when you get to product market fit, it really becomes about scaling. And that's like a capital problem. It's not, what the value that the investor is providing at that point is the money mostly. And so it's just a materially different investment profile in our opinion, and one that I think, again, our belief is over a broad enough, series of companies, over whole sectors, and over a long enough time, is actually a very attractive risk return profile.
Now, with that said, so even if you look at Series B stage companies and look at a specific category, whatever that might be, data orchestration, data integration, vector databases, like you said, you might know all 5, 8 of the ones that are at that stage that have revenue that can raise a Series B. But if they're platform kind of companies, there's not going to be 5 winners or 8 winners in that category, probably 1 or 2. So how do you make sure that you get all 8 of them into the Fundrise platform so that I can, I'm sort of have some kind of guarantee that whoever wins, I'm in?
Yeah, I think, again, great question. So like you said, probably not all 8 win. A lot of
and by definition, if it's a platform, if it's a piece of infrastructure, maybe there's 2 or 3 that will dominate, and then the rest will survive, but they're not going to be as dominant, right? So
and our goal would be to kind of get across as many of those companies as possible, and that's where it comes into understanding how do we structure a fund or a capital source for those companies where it's just a very attractive proposition for a founder to bring us in as a strategic investor, which again, I think the structure of our fund is so different. We're just kind of a different animal, a different type of investor than a traditional venture fund. So we don't have a desire to be the majority investor or the lead investor. Actually, the way our fund is structured, which we can talk about a little bit, we actually can't have a controlling interest. We're passive, like almost not only by design, but kind of by regulation.
How about board seats?
We can't have a board seat. So it's when we set out to create the fund, we say a lot of ways we created a capital source that was kind of our dream capital source, right? We started Fundrise we had to go out and raise money just like everyone else to build the company. And we had this kind of idealized version of a capital source that, had a lot of capital, but was very passive, kind of let the founders and the management team run the business, was long-term, and wasn't just pushing you constantly to like, raise more money, increase your valuation, go public sooner. And so when we built the fund, we said, okay, let's design something that's exactly like what we would have wanted. And in that way, make it very attractive to all founders, to all CEOs, so that we can kind of.
But so part of your your assumption is you can get to diversification. So like you said, so take any category in data infrastructure, you're sufficiently diversified so that you're invested in the 5 to 8 companies that can raise a Series B.
Yeah, that's
but then the if you don't have a relationship with the founders because you weren't there at the seed, how do you convince them to take your money at the B round?
That's the work. That's the work we're doing now. But I think we start out where we're founders like they're founders. I think we have a good sense of what founders want in a capital source. Like I said, we're passive by design, right? We can't have a controlling interest. We can't have a board seat. We're long term, so the fund's evergreen, right? We don't have a fixed life. We don't need to show markups to raise our next fund. So we'll hold the fund, we'll hold the investment for forever. So that means not just through many rounds, but also into basically going public. And then I think the thing that's two things.
So do you do like follow on?
We would do, again, yes, we would do follow-ons. We would continue to invest in the company. I think it's, we expect it to be a very large capital source relative to a lot of funds. There are obviously massive funds that have become very popular over the last few years, but
the unnamed Tiger Cubs.
Yes.
Yeah.
I think the two other things that are distinct about us are the fund, the way we structured it from a fee model. It's a flat fixed low fee fund. So there's no promote, no carried interest. So our incentives as the managers is not to kind of hit some home run and have a massive exit and then keep that 20% profit that ends up being hundreds of millions or more to the fund managers. It's about long-term stable performance for our investors. And then the second one is kind of the most unique thing, which is we have close to 400,000 investors on the platform. So what we bring with our capital is this kind of like people power, basically, where a lot of the companies that you're investing in Series B, we have tens of thousands of engineers and customers.
So Brandon, so for people who aren't familiar with the platform, let's say you have a category in data infrastructure, whatever that might be, right? So vector databases, orchestration, data integration, whatever. So what's in the user interface? Are you investing in data orchestration? So what are you investing in?
So the investor on the Fundrise platform who's coming to us is investing in our fund, which is named the Innovation Fund. Within that, we've identified certain sectors that we broadly.
So it's much more kind of a broad, diversified fund. It's like an index of the data infrastructure space. But
Correct.
Then the assumption is, the hope is that in each part of the stack or each component in the stack, you have enough diversification.
Correct.
So that in that part of the stack you might win. But overall, the idea is maybe even if in this component of the stack you don't have diversification, overall you have diversification.
Correct. And so again, over time, I think over time, the goal is just increase again the number of companies, the amount of diversification that we have, our kind of exposure or coverage of the sector, such that over 10 companies you might get one, over 20 companies hopefully you get one or two, over 50 companies. Again, you're getting exposure broadly to the data infrastructure space, and if you're a believer that the data infrastructure space is one that's growing, is going to have basically a big market share, then in our opinion, again, being indexed across that is a very attractive risk-adjusted return.
So then if you're a founder, you're about to raise a Series B, you either I guess there's tiers, right? So you're either one of these super hot, high revenue companies, everyone is throwing you money, or maybe you're in the middle tier where some are saying yes, some are saying no, and then you may be at the tier where you're struggling to raise that Series B. So how do you get to the hottest of the hot companies, right? So so that's the challenge. Because then what's your differentiation? What do you bring to the table in terms of for them? I guess we've kind of discussed it a little bit in terms of long-term stability of the investment, right? But traditional VCs might say, well, we can give you other support, right? So for operational support, marketing, so on and so forth.
Yeah, I think again the VCs have a pitch around, we can help you, teach you how to run the business. We
make introductions
to other capital sources. I think
or just like if you want to get into government contracts, we have contacts there and so on and so forth, right? So
yeah, absolutely. I think the thing again for us, our goal is not to replace that venture fund, it's to invest alongside them and bring something that they can't. It's in a lot of ways we're very unthreatening to that fund. I think again the big thing we bring is we bring the people. So let's say we make an investment in one of these companies we're talking about, we're going to spend a lot of time with their marketing department, their business development department, essentially introducing the company to our customers. Why is this a great company? What do they do? How are they growing? And more or less provide like a level of marketing.
But wait a minute. So you said if I'm investing in the data infrastructure fund and Fundrise, I can see the data infrastructure fund, right? So, but I don't know what you invested in to get to that fund, right? Do I?
No, you'll know everything. You'll know all the assets that are in it, and you'll get regular updates on those companies about both.
So then what you're saying is those investors might end up becoming sort of like supporters and cheerleaders.
Yeah, I think supporters, cheerleaders at minimum. I think we've already seen in our investor base that in a lot of cases they can actually drive business. I mean, they can drive referrals. They're oftentimes customers of the product. I think of like, something that Uber did 10 years ago, right? When early on, at least here in DC, the DC Council basically was trying to shut down Uber. And then Uber sent out an email to all its customers in DC saying, hey, if you love Uber, send this email to your council member. And within a day, the DC Council got more emails than they'd ever gotten about anything, and immediately flipped and basically went from being about to shut down the company to basically structuring regulation around it to allow it to succeed. And that amount of people power you can get from kind of an active, engaged customer base. I mean, again, remember the investors in this fund, they want these companies to succeed, right? If they succeed, they're going to succeed as investors. And so, we've done it a little bit on the real estate side. I think there's even more of an opportunity to do it here with the technology companies, but like basically empowering the investors to be advocates, to be activists, to help drive the success of the business. And at different stages, that's going to mean different things. But as we grow, having 500,000 or 1 million people kind of trying to drive the success of your company, I think that's something that basically no venture fund can actually bring to the table.
So there must be a reason why you folks went from started to get into technology, venture capital investing, in choosing data infrastructure, potentially machine learning and AI as your starting point. Is it because your customer base? Is there something that you got from your customer base? In other words, because part of what I'm hearing from you is that one of the things you bring to your table is this customer base could be like good proponents for these companies, right? So is the makeup of your customer base somewhat kind of reflective of the decision to get into tech?
It definitely influenced it. I mean, we looked at first what have been the most successful alternative asset classes over the last several decades, and tech investing is absolutely one of those alongside real estate. And then we looked at, what areas are, the most difficult for average retail investors to get access to. Tech investing is one of those. and then which is most interesting to the customers, and which one do we think that they can bring, the most leverage to bear on. And by far, real estate was always kind of the number one, and tech was always the number two. And so in a lot of ways, yeah, our customers told us, if you were going to offer something else, we love what you've done with real estate. If you were going to do something else, tech, we want to basically get access to venture. And like you said,
And why data infrastructure?
That has more to do with kind of how we think about investing, like broadly as a philosophy. We're very broad thematic investors. So we don't think
And
that
also, it's kind of foundational, right? So even if you want to get into AI later, do
Yes.
the foundational data
Yes.
infrastructure
Yeah.
first, right? So
Yeah, we look for basically what are the areas where the kind of tailwinds of the major trends that are going on in a space are going to grow that industry, grow that space. And then, as you said, they become foundational to kind of everything else. And so for us, data infrastructure was probably the best example of that. It's one of those areas that, in our opinion, you're just going to see, more and more companies basically adopting all these tools and software companies that are out there to make data accessible and usable for those businesses. We just feel like we're at such an early stage in the growth of the industry that there's just such a big tailwind behind it that there's going to be a lot of winners in the space just as a factor of the size of the market itself growing over the next 10 years or so. And so it's how we think about real estate. We look for broad trends over 10 years and really just try and again capture an index against that trend rather than pick a specific building or a specific city or a specific company that's going to
so
be
how constrained is this initial data infrastructure fund? In other words, if you decide later on we should start in bringing in some AI application startups, is that a separate offering, or you just
that would be all within the same fund? So we've identified really 4 spaces that we feel very strongly about, data infrastructure being kind of the most the first and biggest that we're focused on. We do believe the AI ML space is kind of by de facto on top of that also going to see a lot of growth, but probably even earlier in the stage. And then both fintech and prop tech, I think we would say we're less bullish on the entirety of the space. We have such a strong familiarity with being a fintech company ourselves and being a real estate operator ourselves, where we have really like a deep amount of knowledge and exposure to that space.
You didn't mention Web3 or metaverse.
Yeah, not
just kidding.
Not areas we're focused on. But yeah, that's where we're starting. And so for the investors, they understand here are the areas that we really feel bullish about. Here's why we feel bullish about them. Again, our goal is to set out to basically invest across as many of the great companies in this space as we can.
So as far as companies that you're marking as eligible, so Series B and beyond, what about geographic regions? Is it mostly US? Is it mostly Silicon Valley and where you folks are, DC, or what are the parameters for founders?
Yeah, it's we're definitely first focused on US based companies. We're really geographic agnostic, I think.
So why US based only? Is that a regulatory?
It's not regulatory. We certainly could go outside the US. I think we just had to narrow the scope somewhat to have a focus point. So I think for us, that's, in terms of getting, relationships and kind of getting in touch with some of the founders and connections that we have through, the industry, it was a kind of a logical place for us to start. But no, there's no regulatory restriction on us expanding into companies outside the US, which I expect we will do. But, we had to narrow the focus somewhere. But within the US, we're geographic agnostic. I would say, obviously, there's a lot of companies, in the Valley. The only thing I think I would probably differentiate about us is we got started in DC. We're not from the Valley. So if anything, I think we're predisposed to be more open.
Neither were the not to be named Tiger Cubs.
Yeah. We're also not based in New York. So
yeah.
We tend to think that there are good companies outside of New York and San Francisco. Although
So
there are a lot.
for founders, in terms of the cap table, there's only going to be one investor in the cap table, right? So
Yeah, our fund looks just like any other, fund. If anything, it's closer to it's a registered investment company. It's a public fund, just like a mutual fund. So, it's one fund, one investor on the cap table, and that fund is a public fund that goes through SEC registration. It goes through audits, and so it's the idea that you would have hundreds of thousands of individual investors in the cap table. That's no, founders don't need to be worried.
what kind of due diligence do you folks do in terms of, or do you farm that out like the not to be named Tiger Cubs farmed out their due diligence, right?
No, I think we actually take the opposite approach. So we are a technology company. We have, a team of 100 plus engineers. A lot of the due diligence we're doing now around the data infrastructure companies is our team actually adopting the products, using them internally for our own business purposes. And then our engineering team comes back to us and gives us feedback on whether they like the product, how effective it is, if it's something we should maintain. So in a lot of ways, like I think we're do certainly different, but I guess I would say more diligence than the typical venture fund, because we're customers of the product and we actually have a strong technical team here who can live it day in and day out, and really has a in our opinion, I guess a good view on kind of what a great data infrastructure technology company looks like, because they have to build with it and use it every day.
So by the way, we keep talking about Series B, but is this mostly a semantic thing? Are you mostly looking at traction and revenue? So in other words, if I bring you a company that's technically Series A but doing well, so
yeah, that's a shortcut. Exactly. It's just we're looking for companies where there's traction, and that traction is, again, they've found kind of product market fit, and what they're looking for is scalable capital. We don't, at this point, we don't really feel like our expertise is that pre-seed or seed stage where you're assessing the technology before it's even built. As we grow the fund, as we grow the team, that may be an area we expand into. But again, we kind of focused on the place that we felt like we were going to be most capable. And so that's why we've kind of got the focus area that we do right now.
So one of the most kind of interesting and disruptive things in the area of financing tech companies has been this thing called direct listings, which has to do more with how companies go public. But is there an analogy here to direct listings?
Yeah, I think to me it's like almost the exact same philosophy. You have a great company, you have the end investor who's interested in investing, and then before you would have an investment banker, basically a financial intermediary who would try and sit in between those two places and extract out a ton of value for themselves. Again, I think in the case of like a Google or other companies, they don't need the investment bank to do their traditional work. And so the direct listing was a way of taking the value that otherwise is extracted by the financial industry and giving it back to either the people building the company or the people who are actually investing. I mean, it's almost identical to kind of what we try and do with Fundrise, just that's focused specifically on the IPO process. And we're really more focused on pre-IPO,
it was great for employees too, no lockup.
Yeah. I mean, to us, it's like philosophically exactly the same, focus of ours. It's just a single point in time or a single transaction, whereas we're really focused on kind of everything leading up to that stage in the company's life cycle.
So how do founders get in touch with Fundrise?
We created a email handle, which is notvc@fundrise.com. We thought that was easy enough for people to remember, but that's the easiest way, and people can reach out. And yeah, right now we're just fortunate to have a fair amount of people reaching out and just interested in learning more. And again, I think our experience is a lot of the founders we're talking to, we've lived the same challenges of raising venture money. We have the same frustrations, the same hesitations. And so it's just a very easy conversation to say, like, a lot of the things you're going through, we went through, and a lot of things you're interested in kind of doing differently were the same things we wanted. And so, yeah, it's been great to talk to companies and founders who are just starting out and being able to like share these stories of what they'd like to see differently in terms of how they're raising money and who they bring into their company. So it's been really great to meet a bunch of new founders.
And the goal is to get this fund and style of investing in high gear in 2023, correct?
Yeah, 2023. I think it's always good to be lucky, and it's I think a lot of people feel like the next 12 or 24 months can be a very good time to be investing, into the venture market. So if we had started in, end of 2020, 2021 would have been a little more challenging. So, yeah, better to be lucky than smart. And so we're very excited about kind of the environment we're investing into right now, in terms of, valuations and pricing, and people just being a little more realistic about, where things stand.
And with that, thank you, Brandon, and we look forward to following how this Fundrise approach to, I guess, mid-stage investing plays out.
Yeah, this is great. Thanks so much, Ben.